And so we expect the FOMC to start reducing interest rates around the middle of this year. Inflation is still too elevated for the Fed's liking. Whatever measure you look at, CPI, PCE, inflation is too high for the Fed's comfort. Wage growth is also too strong for the Fed's liking. Wage growth is at over 4% on a year-over-year basis. The Fed will want that to be closer to 3% on a year-over-year basis. So we do think that the Fed will want to see more encouraging inflation data. The inflation reports from January and February weren't great, but the Fed usually doesn't overreact to one data point. So we do think that we are going to see better inflation prints in the next couple of months, which should put the Federal Reserve in a good position to start reducing interest rates around the middle of this year.
What if I told you, Olu, that there is an expectation and a growing one at that? We just had Neil Kashkari point out that there might be a growing case for no rate cuts this year.
No, there's been a lot of Fed speak in recent weeks, and I think that the balance of risks is tilted towards less cuts than more cuts. And I think that's really mainly due to the inflation prints, which we've had so far this year, the January and the February inflation prints. Our view is that, those are anomalies. We think that we're going to see better inflation prints over the next few months. So the two stickier components of inflation now are core services and shelter inflation. As the labor market normalizes, as we get slower demand from businesses and establishments and improvements in supply, that should contribute to lower core services inflation. And also, many private market measures of rents are currently showing slower rent growth. And, that is going to translate to lower shelter inflation and lower CPI inflation. So we do think that's the inflation prints, which we have seen so far this year. We think those are anomalies. We think we're going to see better inflation prints in the next couple of months.